Hey there, welcome to the Open. U.S. President Donald Trump extending the ceasefire, but the Iranians firing on 3 ships around the Strait of Hormuz. Investors don't seem too worried right now. Let's get to the big stories we are following in the BNN Bloomberg newsroom. Huge expansion here by the owner of the Toronto Stock Exchange. TMX Group is buying CBOE Global Markets Canadian and Australian units in a deal valued at about $300 million US. The TSX owner says the acquisition will expand its global footprint and support long-term growth. TMX says it expects the transaction will add to earnings within a year, but it's still subject to regulatory approval. Rogers Communications posted first quarter revenue above expectations and it matched profit estimates. Rogers Sports and Media revenue grew 82% year over year after the company increased its stake in Maple Leaf Sports and Entertainment. Rogers added 28,000 post-paid mobile subscribers during the quarter, and more than double what analysts had expected. Revenue in the latest quarter at Metro beat estimates, even as profit came in short of expectations. The Montreal-based food retailer saw sales rise more than 4%. However, Metro is warning that a strike at its Laval, Quebec distribution center could weigh on results in the current quarter. Metro says it has a contingency plan in place for distribution, and its Quebec stores are generally well stocked. And there's a look at U.S. futures. They are up despite reports that the Iranians fired on three ships in the Strait of Hormuz area. U.S. President Donald Trump extending the ceasefire with Iran for now, but says the blockade of Iranian ports will continue. Let's get into some of today's earnings reports today, including Rogers Communications. Actually, Rogers increasing its forecast for free cash flow this year. We've also got numbers from GE Vernova. Let's bring in Paul Harris, portfolio manager at Harris Douglas Asset Management. Paul, great to see you, and thanks for joining us.
Pleasure. Thank you, Andy.
Give us your quick take on the Rogers numbers. I know you probably haven't had that much time to look into them.
Yeah, I think what was interesting about the Rogers numbers, like outside of other things, was the reality was that they were bringing down CapEx almost by $1 billion, which I think was really interesting to see, and that they've increased their free cash flow by almost $1 billion, which actually works together. But I think those were the 2 big things that are very interesting. And I think that what they mentioned was that this is going to be much more of a stable number for their CapEx spend, right? So I think that was very interesting about Rogers. They kind of beat some of their expectations, which I think was important. But I think those were the big things that kind of the CapEx spend coming down, the free cash flow numbers going up, the integration, the MLS deal going through. I think they sold off some of their data centers, which has helped them. So I think that's kind of what, Rogers has sort of restructured itself and I think is looking a lot better these days.
There is a sense of caution on Bay Street about a lot of the telecom stocks, including our parent company, BCE. Some analysts worried about competition. Are you heavy on, do you own a lot of telecom stocks right now, Paul?
We don't own BCE, but we do own TELUS still, and I think that TELUS I think it'd be interesting because they've got a new CEO coming in, so I think they'll be who's obviously run a big major bank in Canada, and so maybe we'll see a lot of different things happening at TELUS. But I do think I think that the issue that with these companies face is this constant issue of competition from the CRTC. Always feeling that there's not enough telecom companies in this country, especially on the mobile side. And I really feel that that's just been a big issue for these companies. And I think it's probably a bad thing because, if you look at the States, there's not that many telecom companies there either, right? It's a much larger country. And we have a lot of other issues where from a telecom perspective, a lot of people live in sort of very southern parts of Canada, and you're required to do a lot of other things to fulfill obligations on kind of rural areas, et cetera. So it becomes very taxing on these companies on a capex basis, right? So I do think the CRTC is sort of has this very I think there should be better regulation about how they can increase fees, et cetera. That would be a better way of looking at it, sort of saying, oh, we need more and more competition. I don't think it really works in this country. It hasn't. It's shown that it hasn't worked in this country. When a new telecom player starts up, they kind of end up getting bought by one of these players in the end, right?
Well, yeah, but Quebec Or is making waves. They're expanding rapidly.
Yeah, so I think their deal worked out, right? So I think, yes, you actually have competition. That's what my point is. You already you have enough. You don't need more, right? So, and if you get smaller players come in, inevitably they end up getting bought up by somebody else, by one of these bigger players, because they can't actually, run their business effectively. And so I think it's just a bad methodology for thinking about the telecom sector. I mean, they should really rethink how they look at it, is what my view is. And there's lots of competition in Canada, right?
GE Vernova has been something of a darling with investors, maker of power equipment, turbines, and of course, seeing big business with the data center build out. Stock jumping in the pre-market. Maybe we could put up a 5-year chart. Would you be a buyer right now of GE Vernova, Paul?
No, I think the issue was when GE split up, it's really the individual parts have done incredibly well over the last several years since they've kind of split up their businesses into 3 different businesses. So they've all done quite well. This has been the exception, and I think it's also been helped by the fact that you've seen this continued growth on the energy side, and this is a component that it's done very well from. I think those data center areas may have some issues over the next little while. I think you buy it on a pullback, but I think it certainly is it's a company that's incredibly well run these days. It's benefiting from a great deal of tailwinds, which I think will continue. So I think if you can get it on a pullback, yes, you should buy it.
What about Metro? They had this short-term, well, I guess the company hopes short-term threat of a strike. Are you a holder of the big food retailers right now, Paul?
Yes, we do own Metro, and I think we continue like we saw the numbers were very positive. I think on the strike basis, you're going to have to deal with it. This is an ongoing thing that happens, and so I think hopefully they will be able to come to some kind of conclusion, and it doesn't have a major effect on their following quarter, right? So, but I think that when you look at their numbers, they were very good. They continue to grow slowly, and I think that it's a great business. The pharmacy side did very well, not only on pharmaceutical products, but non-pharmaceutical products did very well as well. So I think it's got all things are working well for it. I think this issue with the strike may be a difficult thing that they have to go through, but it's not a long-term thing that's going to affect the company over the long term, and that's what I tend to look at.
Finally, Paul, are you paying much attention to the Fed and the hopes of President Trump to appoint Kevin Warsh as the new chairman?
Yeah. I mean, I think that, I listened to some of his commentary. I do agree that the Federal Reserve is sort of moved out of their lane. Like, I think that that's really been the case with the Federal Reserve. And his point that is that once you move out of that lane and get into fiscal policy and environmental policy, you're putting yourself from a political point of view at risk. So the job of the Fed is monetary policy. They have to stay in that lane. I think the Fed has done a poor job in many ways of 2 things. One, letting way too many people in the Fed talk about the Fed policy. Let's just, that was a Ben Bernanke thing. He wanted more transparency, but it's just too much transparency. It's good for media companies like yourself, but it's not really good for the stock market or the capital markets generally. I think one person should speak that. The other thing I think about the Fed is that they've expanded their balance sheet way too much. I think the issue for that was you have to expand your balance sheet when in very risky times. COVID was a perfect example. He liquefied the system. He increased the amount of U.S. dollars in the system. He reduced interest rates really quickly. That saved the global economy in COVID. But you've got to stop those things once things get better. And that's kind of the idea. You're the lender of last resort. And that's what you're supposed to do. And then when the problems are in better shape, the economy's in better shape, you pull back. And I totally agree that the Fed should be pulling back on their balance sheet. There is no way it should be so large. And it causes a problem if we ever go through a 2008 or, God forbid, another pandemic, that you don't have the capacity necessarily to do what you had to do, right? So I totally agree with him about that aspect of it. Whether, he's going to lower rates because of Donald Trump, I don't think that basically, I don't think he can in many ways because he only has one vote. He has to convince everybody else to drop rates, right? So it's not, there's 12 people on the board. He's just one of those votes. And, he may be able to convince a couple of people, but he has to convince the majority. And I think from how he's spoken previously about the Fed and its role, et cetera, I don't think he would do that to satisfy Donald Trump. I think that he would, do the job that's required of him.
Paul, thank you very much indeed. Paul Harris, Portfolio Manager at Harris Douglas Asset Management. Coming up, we'll take another in-depth look at the markets and we'll put the focus on Team Canada's trade team and a new chief trade negotiator being named who says it is time for the US, for the Americans to bring something to the table after all the concessions Canada has made. Let's take a quick look at the markets. We'll see how major Asian bourses finish the day. And you can see Japan hanging in there, not far short of 60,000. And China's blue chip index almost at 4,800. Let me give you a very quick scorecard for the Asian markets this year. S&P 500, as you know, is up about 3%. Toronto's up almost 7%. And the Chinese market, CSI 300, is up almost 4%. Let's have a quick look at Europe now. And stocks there under a bit of pressure amid the to and fro in the Persian Gulf. Iran firing on ships, as I mentioned earlier. The Euro Stoxx 50 index, one measure of big stocks in Europe, is up only about 2% this year because, of course, Europe is at risk of an energy crunch with this shutdown of the Strait of Hormuz. And let's have a quick look at U.S. futures. As I mentioned, the S&P 500 is up about 3% this year, and it is set for a higher open, it looks, after U.S. President Donald Trump extended the ceasefire with Iran. And the S&P 500, where is it there, 7142, it looks like it's going to open in record territory. The previous record close was on Friday, 7126. And let's have a look at Boeing. Boeing is higher now. It bled less cash than expected. It was lower than expected cash flow, and it delivered the most aircraft in the first quarter since 2019. The Prime Minister named his huge new Trade Advisory Council. Attention turns to what that group's job will be. It's a group of largely familiar political faces, along with a mix of union, industry leaders, and big names in finance. So it's getting down to business as these CUSMA trade negotiations approach. CTV senior political correspondent Mike LeCouture has the latest.
As the cross-border tensions ramp up in the playoffs, the Prime Minister is assembling his own team to enter the trade arena with the U.S.
I'm very pleased to have that group. It's a diverse group, leaders from the union movement, experts in industry.
Carney's reconstituted Canada-U.S. Advisory Committee brings together 24 CEOs, former politicians, and business leaders. Holdovers from the previous version include Unifor President Lana Payne, former Quebec Premier Jean Charest, and Flavio Volpe, President of the Automotive Parts Manufacturers Association. Now, there are plenty of new faces, including former Conservative leader Erin O'Toole, the President of the Aluminum Association of Canada Jean Simard, and the head of the Canadian Chamber of Commerce.
We can't forget about our small and medium enterprise businesses. That's 98% of our businesses.
While Conservative leader Pierre Poilievre didn't criticize the committee, he took aim at Carney's pace of negotiations.
He's done absolutely nothing on this file in the last year other than use it to stoke fear.
The minister leading trade talks with the U.S. pushed back on that idea.
Negotiations necessarily don't take place in public. We have made a deliberate decision not to discuss the content of our conversations with American officials publicly.
There's a lot of focus on July 1st, which is kind of a checkpoint. It's not a cliff.
Speaking to a business crowd, Canada's lead trade negotiator with the U.S. downplayed the deadline for the CUSMA review.
There is no need to renegotiate. There's no need to open it up and change fundamental underpinnings of it. It is a robust agreement.
While Charette said Canadians will need to hold their nerve, she also warned we may not go back to the tariff-free existence we once had. Mike Lecouteur, CTV News, Ottawa.
The Open will be right back. U.S. Federal Reserve Chair nominee Kevin Warsh faced pushback and questions from the Senate Banking Committee yesterday. Now, President Trump's pick said the central bank should remain largely independent from political influence. We got more from Blake Gwynn, head of U.S. rate strategy at RBC Capital Markets.
A lot of the conversation was kind of focused on the independence issues. There was a lot of conversation around Warsh's finances. And at least when they touched on monetary policy topics, things that would be relevant to the market, I thought he was largely reiterating stuff that we have already heard from him. So it's a bit of a disappointment. I was kind of hoping he'd be pushed a little bit more on updates to his views, whether his views on rate cuts have changed in light of some of the events in Iran over the last month, things that we haven't been able to get from him because we haven't really heard him speak in a while. But unfortunately, it was largely repeats of things and views that we've heard from him already.
He wants to rethink how inflation gets measured. Was he clear on how he would do that, what changes he sees needed?
Yeah, I mean, look, I think everybody would love to have better inflation metrics. He mentioned this kind of billion price thing, which, there is a billion price project out there. A lot of people have come up with new measures over recent years. Even the Fed has kind of used various metrics over time, trimmed means. You've heard at various times them focusing on things like supercore, things like this. So, look, we'd all like to have better ways to measure things, and I think the Fed and BLS and others are constantly innovating on that front. I don't really think that's something particularly novel to Kevin Warsh and something that I think most economists would like to see.
Was there anything that did strike you from what you heard today that was novel or new?
I did think it was at least notable that we had a reiteration from Senator Tillis that he would not be moving forward this nomination until the issue with Piro and kind of these subpoenas that they had served over the construction project to the Fed, kind of this investigation into Powell and this building project. He kind of reiterated that he's not going to move this nomination forward until that issue is wrapped up. So there's a bit of a standoff here between the administration and the DOJ and Tillis on this front. I think maybe the administration had been hoping he would kind of back down, but he does have the power to stall this, just given the split between Democrats and Republicans on the committee. So he can hold this up, and it does look like, according to his comments today, he still intends to do so. Now, he did say he was in support of the nomination. So, once this issue is wrapped up, once they kind of the administration pulls away from this investigation into Powell, he will presumably be a yes vote. So it does look like Warsh will be eventually confirmed. It's just a matter of timing and how long it's going to take these other issues to be wrapped up to his satisfaction.
Is it likely that the DOJ will move away from that investigation?
I mean, it does seem like it has to happen at some point. I mean, he's been pretty clear on that. Now, there is a deadline on May 4th. They had 30 days to kind of file an official appeal on the quashing of the subpoenas that were served to the Fed. So it is possible that's a kind of quiet off-ramp for the administration. They could just kind of quietly not apply for that appeal, and presumably that time frame would close. And I would think that would be acceptable to Tillis to kind of continue the nomination. nomination process. But if they file, no telling when they're going to back away. And I will say comments from Trump, comments from Pirro, who's handling the case, it doesn't appear like there's any signs there that they're backing away.
Okay, we see Warsh also talking about shrinking the Fed's balance sheet. I'm wondering what that would look like, how that would affect, interest rates or the broader economy.
Yeah, so, we've had some great research from current sitting Fed officials over the last month or two that have gone through a real comprehensive list of ways that the Fed could try to get the balance sheet smaller. These range from very extreme, taking us back to kind of old ways of doing things, pre-crisis type of ways that the Fed used to operate, to much more smaller, marginal type of things that they could do to change the composition of their balance sheet in ways that would allow it to get down, potential changes in regulation. So there's really great resources out there. There's great work that the Fed is already doing to kind of create this menu of options that could be on the table. I thought one thing that was notable from Warsh's comments today, and something that we've been arguing, looking at the analysis that we've had from these other Fed officials, is that this is going to be a very slow process. That was something that both of those papers I was mentioning have highlighted, that this is going to be very slow, very deliberate, that you need to do more work in analyzing how these different options would work, what the impact would be on the economy, on markets. And then even once a decision was made, it's likely that those would be rolled out very carefully, very slowly. So we heard Warsh kind of back that up today. So he did reiterate that he wants to see a smaller balance sheet, but did say that this is going to be a very gradual, very slow, very deliberate type of process.
You mentioned the possibility over a standoff for the charges against Jerome Powell, for the renovation. Do you see anything else perhaps holding up his nomination?
No, I think it's once that is a go. I think he has the numbers. In the hearing today, it didn't really seem like you had any Democrats who were, really moving to support, or any Republicans that were moving. But more importantly, any Republicans that were kind of wavering on their decision. It seemed pretty clear that all of the Republicans were lined up to vote for him. It was only Tillis that was holding out. So as far as we can tell, it really is only that issue. As soon as that issue is cleared up, they will almost certainly very quickly hold a vote. And I don't see any other holdups for Warsh to taking that seat.
We've got the opening bells coming up. Let's have a very quick look at the S&P 500 over the past year. Practically back as of a record highs as of yesterday. In fact, we could open in new record territory today. The Wall Street Journal says that from day traders to hedge funds, investors are once again running full speed into stocks and loading up on a risk. Despite the shutdown of the Strait of Hormuz, there's a belief that U.S. President Donald Trump is ready to reverse course if stocks sell off too badly. We're going to have those opening bells next. There we have it, the opening bells on Bay Street and Wall Street. At the NASDAQ, Yesway, which is a Texas-based convenience store chain that just went public, ringing the opening bell. At the New York Stock Exchange, GE Vernova, the maker of turbines and a darling among investors, ringing the opening bell. And at the TSX, it's the World Federation of Exchanges. It's the Clear Conference opening the market. It's time for the first 50. Let's check into North American stocks as we get going on this Wednesday morning. And you can see shares are up after U.S. President Donald Trump indefinitely extended the ceasefire in the Strait of Hormuz. However, Iran apparently fired on some ships, and America is officially, anyway, sticking with its blockade of Iranian ports. So there is the S&P 500. It has been trading in record territory. 7115 is the open right now. So we're slightly down from Friday's record high close. And there is the NASDAQ at 24,457 and 457. It is only slightly down from Friday's record high close. Toronto not far off its all-time highs. And let's have a look at some stocks on the move here, or companies reporting earnings. Metro has been out of favor with investors and warning that this strike that's been dragging on at its Laval, Quebec distribution center is likely to affect results in the company's latest quarter. However, Desjardins saying the Q2 numbers that they just announced were in line with expectations. And Rogers, a rival to our parent company here at BNN Bloomberg, BCE, that stock jumping around 6%. Just once again going with some Desjardins analysis here. They are cutting back on CapEx, and Desjardins saying that's likely to be well received. Remember, there are concerns about heavy competition in the telecom space. But you can see Rogers stocks had quite a bounce over the past year, up almost 40%. And finally, the TMX growing in both Canada and Australia. The market content with that move. They're going to be acquiring CBOE Australia and CBOE Canada in a deal valued at about $300 million US. Let's check out some movers south of the border. We are joined by Bloomberg's Janine Panzer. Janine, thank you very much indeed for joining us. Best Buy is naming a new CEO. Give us a bit of color on that, if you would.
Best Buy is naming a new CEO. He's actually a long-time veteran. He's been with the company since the 1990s, but the market's not liking that. The shares are under pressure at the open. So Jason Bonfig's taking over from Corey Berry at the end of October. He started out as an inventory analyst, and now he oversees the core business, merchandising, e-commerce, marketing, and supply chain, including, of course, for us, Best Buy Canada. And this is very much, as we can see, a continuity pick. Berry, though, she's stepping down after about 7 years in the role, which is actually a solid run and towards the higher end of what you typically see for Best Buy, where CEO tend to run about 5 to 7 years. And as for the business, the stock has been under some pressure this year as demand for consumer electronics continues to normalize after the pandemic surge.
Right. I'm just looking here at a 5-year chart for Best Buy. So the shares trading in the high 60s lately, but they're down from $138 in 2021. I guess in the pandemic, everybody was buying electronic equipment because they had to stay home.
Yes, so they have like I mentioned earlier, that the surge from the pandemic is kind of waning, but they have some recently bright spot with the Nintendo Switch. And analysts are actually saying that Best Buy has trying to dabble in, like I said, not just electronics, but actually have some furnitures in the store as well. So help offset that.
And let's talk to us about GE Vernova, if you would, the maker of turbines and seeing big business as they're installed in data centers.
Yes, it's really big day for GE Vernova is higher at the open and adding what has already been a massive run for the company. They say the stock's up more than 52% this year. The company reports earnings today and raised the full-year outlook, but the real story here is actually the orders. They jumped, let me check the numbers, 71% to $18.3 billion, a number that analysts are saying not supporting the growth now, but long-term to the almost the end of the decade. So let's look at some of the segments. The company is saying that the electrification is a standout. Data center-related orders already exceeding all of last year. And wind was weaker, but that was offset by strength in power and electrification. So overall, a beat, higher guidance, and solid order visibility, helping explain the move that we're currently seeing.
Janine, thank you very much indeed. That's Bloomberg's Janine Panzer updating us on some U.S. stocks of interest. Up next, we're going to get more perspective on the markets and we'll drill into more of those earnings. We'll hear from Citi Wealth Chief Investment Officer Kate Moore. U.S. markets higher in early trading, very near to record highs. Let's get more from Kate Moore, Chief Investment Officer at Citi Wealth. Kate, thank you very much indeed for joining us.
Hi, Andy. It's great to be here.
The Wall Street Journal saying today this is a FOMO market and also a TACO market. Okay, fear of missing out on stock gains and also confidence that Trump always chickens out, that if he sees the market slide, he'll reverse course on a policy that's worrying investors. Do you get a feeling of just underlying bullishness right now?
You know, I wouldn't classify the investor base as overwhelmingly bullish, actually. What I would say is that many people sat out from making significant trades over the course of the Iranian conflict so far. The biggest participation we saw was, frankly, across what we call kind of the fast money community, the hedge funds. In fact, you know, more traditional investors, more long-only investors, were kind of waiting to see what would happen, perhaps adding a little bit on some pullbacks. We did some rotations in our own portfolios there. But on the whole, everyone has been just sitting on their hands a little bit, I think, for the last 2 months. So I'm not sure that everyone is looking to put on a lot of additional risk at this moment. There are many things, not just around Iran, not just around economic data, but also around earnings that are going to be very important in order to catalyze an improvement in sentiment.
And history does seem to show that, I know the investment business always likes to say this, keep your money on the table, riding on the turn of the wheel. But generally, the market, or the U.S. market anyway, over the past 10 years and more, has shaken off global geopolitical disturbances.
Yeah, I mean, that's right. And a lot of people have learned this lesson that, you know, you may get a significant amount of negative headlines, but they tend to not play into markets or last in markets for long periods of time. And I think a lot of people were struck by how fast the markets recovered after Trump's announcement around tariffs last April, right? That memory was very fresh for a lot of investors, that if they panicked and took money off the table, then, you know, when the market recovered, they were unable to participate. I think that was a contributing factor to the stasis, I would say, over the course of the last 2 months. But it is also true that throughout history, geopolitical headlines have strong negative impact often in terms of the market, but, you know, then get washed out over a period of 1 or 2 weeks or sometimes, you know, even days. So looking through the noise and staying really focused on the macro and the fundamentals is something that we have tried to do while we continue to build resilient portfolios for our clients.
So far, earnings pretty decent. We haven't seen, of course, the shoe is yet to drop on these higher energy prices, but generally corporate earnings pretty strong.
Yeah, and our expectation is we're going to get continued strong reports over the course of this earnings season. I mean, I think there are a couple things to take into consideration, Andy. The first is that we entered this year with a really constructive view on the overall U.S. and global macro picture. And despite the fact that we've had this geopolitical shocks and, frankly, a lot of concern and worry about longer-term feed-through of higher energy prices, we have, in fact, had very solid, high-frequency economic data released over the last couple of weeks, even some of the data that would factor in the environment post the start of this Iran conflict. So the macro backdrop looks quite good. And what we've been hearing from companies, actually, is that the consumer is in good health and that spending continues and that the investments in some of these core secular areas like around AI and technology continue unabated. I think we're going to find more of that coming out over the course of the earnings season, and actually more companies, particularly aligned to the tech and AI trade, raising their guidance for full year 2026.
I know this is a ridiculously broad question, but what are you telling clients about AI? What's the most important thing?
Yeah, I mean, Andy, the thing that we've been telling clients about AI is that we are not concerned around a bubble in the investment, a bubble in terms of the media attention, a bubble in terms of, you know, corporates discussing it. In fact, I think that investing in AI, adopting AI tools is existential for every business. One of our core messages has been that if you don't hear from companies that they have a strong AI strategy, you should be concerned that in order to stay competitive with their invest their peers in their industry and stay competitive in terms of future investment, they need to be doing that spending now. And even if some of that investment does not lead to a significant amount of return in the quarter in which that spend was made, that shouldn't give any investor pause. In fact, they should say this is important foundational work for the company to transform in this incredibly disruptive and critical technology. So it's essential. And I get worried when people think that we're going to have a back off in terms of overall spending. In fact, any company that says they're cutting their spending is a bit of a flag for me.
Thanks very much indeed, Kate. Kate Moore, Chief Investment Officer at City Wealth. I really appreciate it. Yesterday on Market Call, we were joined by Dan Rahinton, VP and Portfolio Manager at IA Global Asset Management. He was covering Canadian and global large caps, and his top ideas were Microsoft, Taiwan Semi, and Visa. Today on the show, it's Andrei Omelchuk, CEO and Chief Investment Officer at Lineguard Capital Management. The topic, North American small and mid caps. Up next, shares in Boeing got a lift this morning after the Virginia-based company posted a lower than expected cash burn in its latest quarter. That's ahead. Shares in Boeing trading higher this morning after the aerospace giant reported a cash burn that was lower than expected. And the company delivered the most aircraft in the quarter since 2019. However, revenue from commercial aircraft deliveries did miss expectations. We're joined by Gavin Parsons, U.S. aerospace and defense analyst at UBS. Gavin, thanks very much indeed for joining us. Always a lot going on at Boeing, a pillar of America's industrial economy. What jumped out for you in the latest quarter?
Thanks. Good morning. Yeah, look, the free cash flow beat is a great start to the year. Boeing still has a lot of wood to chop, but it's a $1.5 billion burn. Consensus was for a $2.3 billion burn. And really what's important is that all three of the businesses, so commercial, defense, and services, are what are driving the underlying improvement in free cash flow here. And the company reiterated the positive $1 to $3 billion free cash flow guide for the year.
Let's put up a 5-year chart for Boeing, or even a 10-year chart. Obviously, they had tragic crashes. There was evidence of weak regulation or regulatory capture. The stock is off its lows.
Yeah, I think investors trade this stock on short-term concerns. And if you can have some risk retirements provided by the company, so progress on certification for the 777X program, continued production rate increases on the 737 MAX, which is stable at 42. We expect that to move up to 47 per month production rate this summer. Same with the 787. They're at 8 per month right now. We expect them to go to 9 per month this summer and 10 per month by the end of the year. I think as Boeing can achieve those milestones and remove those risk overhangs, the market will be willing to look out to Boeing's much larger backlog. Boeing has 6,700 aircraft in backlog. Wow. We expect them to deliver 650 planes this year. That's a significant amount of visibility into demand. And I think once Boeing can remove some of those near-term overhang concerns, the market will be willing to look out and underwrite higher normalized free cash flow generation.
That's amazing. How many planes are in the backlog?
6,700.
Whoa. So
there's a lot of pent-up demand.
Yeah. So global aviation is growing rapidly.
Well, we've had a bit of a slowdown with higher oil prices and Middle East traffic disruptions. Flight activity was down about 5% year over year last week. So the potential for that to disrupt new aircraft deliveries, I think, will depend on duration and magnitude. But for now, there's a lot of pent-up demand for airlines to replace older aircraft. Right? And higher oil prices actually incentivize airlines to take delivery of new fuel-efficient aircraft. And actually, we saw United Airlines say they were going to take 250 new aircraft deliveries over the next 2 years, even as they're reducing capacity. So I think that's the pent-up demand that you see for replacement, even if growth is not as strong as we might have expected at the beginning of the year, given higher oil prices.
obviously is in this long-term global battle with Airbus. Over the past few years, I mean, Airbus has had its own delivery problems, hold-ups as well. But has Boeing lost significant market share globally to Airbus?
Boeing has lost some market share on the narrow body side. You know, the Airbus A321 XLR, that is optimized at a slightly larger configuration than the Boeing 737 MAX. But Boeing is on progress to certify the 737 MAX 10. That should occur this year, and those deliveries should start next year. So that'll allow Boeing to start delivering a slightly larger narrow body aircraft. And then, you know, over the long term, I really think this kind of comes down to execution for Boeing. You know, the supply chain has affected both Boeing and Airbus, but Boeing has had, you know, labor challenges that they have worked through. Their safety and quality management systems have improved significantly. For example, earlier this year, they had an issue where some tooling was scratching wiring on one of the MAX aircraft. They self-identified that. They fixed the issue. They didn't allow that to disrupt the production line or cascade any quality effects down the production line. So I really think as they continue to improve quality and production rates, they'll be able to catch up some of that delivery gap to Airbus.
Now, they're hoping to revive sales to China, and there's a meeting intended or planned between Xi Jinping, the Chinese leader, and President Trump. Was China an important market for them traditionally?
China was a huge market traditionally, more than 25% of annual deliveries.
Wow.
So, you know, there's certainly a possibility that we see an order out of that meeting. But China hasn't placed an order for Boeing aircraft in nearly 10 years.
Wow.
I think they do need aircraft.
They are working on their own commercial aircraft, the Chinese. But, I mean, ultimately, could they start taking market share from Airbus and Boeing?
I think as we look out long term, you know, they will ramp their production rates, but for now, they're dependent on the CFM LEAP engine. And CFM is a joint venture between GE and Safran. And they are also delivering engines to Boeing and Airbus. So as Boeing and Airbus ramp, there's high demand for new engines. So I think the C919 being reliant on those engines will mean that over the longer term, they can take share, but over the near term, they're also capacity constrained by these supply chain dynamics.
And Gavin, sorry, we've only a couple of seconds. What is your rating on Boeing? Would you be a buyer of the shares right now?
Yes, absolutely. I'm buy rated on Boeing, and I think the key here is that on 2030, I see them generating $20 billion of free cash flow. And I think there's even some conservatism in that, given that's a 13% free cash margin, given they achieved 14% pre-COVID. So conservative at $20 billion in 2030.
Gavin, thank you very much indeed. Gavin Parsons, the U.S. aerospace and defense analyst at UBS. Coming up, affordability blows up on Parliament Hill. The Prime Minister and the Tory leader trading punches in question period. CTV's Rachel Aiello has more after the break. Affordability, inflation, it's a hot topic in Europe, America, and of course Canada. And it came up during question period on Parliament Hill yesterday with the Prime Minister and the Conservative leader sparring. Let's get a bit more from our CTV News colleague, Rachel Aiello. Rachel, thank you very much indeed. Voters feeling oppressed. People hate it when prices go up.
Yeah, absolutely. And we watched that play out yesterday in the House of Commons. You know, Andrew, I think this is really an example of the kind of opposition we're going to start to see from Conservative leader Pierre Poilievre as he kind of sits into his role as potentially now a long-term opposition leader. We had him go repeatedly at Prime Minister Mark Carney about the cost of living, affordability, really trying to point to Carney's economic record, questioning some of the things he said about the state of affordability in Canada, trying to hold him to account for previous comments he made. Carney Bernie shooting back, trying to not let it kind of rile him up or get him shaken by what Poilievre was saying, pointing to the fact that other economic metrics, other things he's thinking are going in the right direction economically for this country, and also making the point that, we've got that spring economic statement coming up next week, alluding to perhaps there could be more to say in that, targeted towards affordability for Canadians. We already know that gas tax change has come into effect as of April 20th. Should there be more that the Prime Minister wants to do on affordability to kind of quell this opposition pushback? I think that's something we should all watch for.
Now, committees are an important watchdog on the government, and where the government doesn't control them, they can bring up unpleasant topics. But the Liberals, as governments have done in the past, now they have a majority, are moving to take control of those panels.
Yeah, absolutely. We just watched that unfold on Parliament Hill this morning. Government House Leader Stephen McKinnon has come forward and confirmed that soon he will be bringing a motion before the House of Commons to change the makeup of parliamentary committees. This is under the precipice of the House of Commons makeup should be reflected in the makeup of committees. And because the Liberals have now gone from a minority to a majority, they want to change the makeup of committees. So what that means in terms of their proposal is increasing the number of committee members on most committees from 10 to 12 to boost the number of Liberals on them. There's a few committees that are already opposition run that will go from 9 to 10 members. And McKinnon saying, kind of bracing for what we already know is going to be strong Conservative pushback, is that they had two options. They either had to force the chair on this committee, on these committees, similar to in the House of Commons with the Speaker, force them to break ties, and that kind of goes against precedents, or they could have shrunk the number of Conservative MPs on committees. They're saying, hey, we opted not to do that. We're actually just going to increase the membership size overall. So that debate's going to start any day now in the House, and because of that Liberal majority, it's expected to pass.
Yeah, nobody wants pesky committees calling you to account. That's the way the game is played, I guess. Rachel, thank you very much indeed. Rachel Aiello, our CTV News colleague. Just ahead, United Airlines has slashed its earnings forecast. Boeing bleeding less cash than expected. We are going to have an aviation roundup after this. Welcome to the second hour of The Open. Here are the big stories we're bringing you from our newsroom. Shares in Rogers jumping 10% today. Now, the company's first quarter earnings were broadly in line. It matched profit estimates, for example. There was a jump in revenue at Rogers Sports and Media, 82% increase after the company grew its stake in Maple Leaf Sports and Entertainment. Rogers added 28,000 postpaid mobile subscribers. That was more than expected. And it's also cutting back on CapEx, and that may be also being welcomed by investors. Revenue in the latest quarter at Metro. The big food retailer beat estimates, but profit missed expectations. Sales did rise more than 4%, but Metro's warning that a strike at its Laval, Quebec distribution center could weigh on results. Another look at Boeing shares. They are moving up. The company posted a smaller than expected cash burn in its latest quarter. And the company saw revenue top $22 billion, ahead of estimates. There was growth, including in the commercial aircraft unit, and it is expecting certification for its delayed 737 MAX 7 and MAX 10 aircraft. The company, the CEO says the company is focusing on delivering defense and commercial products to get it back on its growth track. TSX marginally higher in early trading. You can see holding in there above 34,000 big traders this morning, including Rogers, as we saw, jumping more than $4. Celestica also up. Wow, that's quite a move up in Rogers. Royal Bank also higher. And just looking at other big traders, Hut 8, the crypto player, up around 5%. And let's have a look now at the U.S. market, see how that one is doing. The S&P 500 higher right now, despite more shooting in the Persian Gulf. Apparently Iran attacking 3 ships and seizing at least 1 ship, according to a headline I saw. The S&P 500, though, only just shy of Friday's record high close. United Airlines beat expectations in the first quarter, but as you might expect, cutting its 2026 earnings forecast. Let's get more from David Dietz, Chief Investment Strategist at Dietz Wealth Management. David, great to see you. Obviously, the entire airline industry globally in turmoil with this explosion in jet fuel prices.
Yeah, absolutely. So that's one of the biggest costs that airlines face. And of course, the types of fuel that they use is not the regular gasoline that many people buy at the pump, but the refined jet craft fuel, which trades at a much higher price. And so they've been hit very hard. And so it's very difficult for them to make a forecast. United Airlines was very cautious in their forecast because they don't know, no one really knows how long these energy prices will be higher for longer. What they're going to have to do is they're going to have to cancel some flights. Some flights have already been eliminated from the roster, and they're raising ticket prices. They're raising bag prices. To what extent will consumers push back? So there's uncertainty on the top line, and of course, great uncertainty on the cost of the fuel.
Right. I'm looking at a 5-year chart for United Airlines. The stock was already, there's a 1-year chart. So the stock's peak, as far as I can see, was over the past 5 years, was in January at $117 or so. So it has dropped from that level. What's your philosophy on buying airlines, David? Do you like to own them? They're notorious for their leverage up and down.
Yeah, so airlines, historically, you go back to Warren Buffett, and he swore to his investors that he would never buy an airline again when he had some problems with one of his purchases. So it is a very cyclical industry. It is very asset intensive. You've also got a unionized industry, and they want their share of the pie as well. Yeah. I guess to buy airlines, the one thing that's saving grace right now is I think you have a more lenient regulatory outlook there. We've heard from Secretary of Transportation Sean McDuffie saying he is open to mergers and acquisitions activities. So some of the better run, smaller ones might get some M&A play here, which could be very interesting.
You have some stock ideas for us. Can we start off with Albertsons, the grocery company? You say it's a smaller player, but it's got key positions in crucial markets?
Yeah, there's many ways to evaluate these supermarkets, but one of the most important is how large are they in any particular geographical area. It doesn't matter for a Chicago consumer what they're doing in Denver. And Albertsons has some great brand names, including Safeways, including King's. And so they have key market positions that are very difficult to dislodge in many of the key cities and areas in the United States. What I like about Albertsons, of course, remember, Kroger took a run at them a few years ago, but that was stopped by the prior administration. Now I think we may also have more leniency in the supermarket area. You've got a $17 stock that should earn more than $2 this year, and another 10% perhaps next year, 4% dividend. And so I think that they just put behind them an opioid settlement. The number sounds big, but they can pay it over 9 years. So I don't think it's going to interrupt their cash flow greatly.
That's interesting. Opioid settlement also, a factor for Kroger. And these drugs were sold and they made money off them. Another stock idea you have is Magnum ice cream. Now that's I know now I feel like a Magnum. That one just went public, and it was a spin-off from Unilever.
Yeah, I don't think it's attracted much investor attention. And of course, it doesn't help the fact that their headquarters are over in Europe. But, their sales are worldwide. They're best known around here for their Ben & Jerry's ice cream. So this could be a sweet idea. What I think is interesting is they do have the pole position in some of the key premium ice cream and other sweet snack offerings. They're trading at a huge discount to some of the competition in those areas. They don't pay a dividend now, which is keeping some people away, but they're planning to announce a dividend probably in the early part of next year. I would say it's about 13 times earnings, which is cheap for a food stock. Remember, all food stocks are down. At some point, that group will rebound. I think Magnum is a great place to play for a very interesting set of offerings.
And then finally, Fiserv, the big payments processor. You think this stock is deeply undervalued right now?
Yeah, so this is a $63 stock. They should earn about $8 this year, $9 next year. That makes it dirt cheap. They're involved with 10,000 financial institutions in their payment processing. It's about a 95% market share. They've had a really bad quarter last summer, which caused investors to throw out what I think is mark them down way too greatly. They've got new management, which is establishing credibility. I think this is one of the largest companies in the fintech space, trading way too cheap. They've grown earnings about 25% per year over the last 5 years. Analysts see in the next 3 to 5 years close to 11% earnings growth. Free cash flow about 13 or 14%. I think this is a winner.
Thank you very much, David. Really appreciate your joining us.
Thank you so much, Andy.
David Dietz, Chief Investment Strategist at Dietz Wealth Management Group. Coming up, we're going to stick with aviation, but we're going to talk about Lockheed Martin. They are keeping up that charm offensive in this country. Of course, they want to sell us yet more F-35 fighter bombers. We'll be right back. U.S. fighter bomber maker Lockheed Martin made a stop in Mirabel, north of Montreal, confirming that they want to operate a maintenance depot in combination with U.S.-based defense giant L3 Harris for those F-35s. Canada's already committed to buying some of those, only 16. Naturally, Lockheed is in a charm offensive because it wants Ottawa to buy yet more of these planes. CTV's Quebec Bureau Chief, Geneviève Beauchemin, filed this report.
With signatures and a handshake, Lockheed Martin penned a plan. The aerospace giant's executives landed in Mirabel with a memorandum of understanding on the maintenance of F-35 fighter jets. This executives to maintain, even create jobs.
This partnership that we're here to celebrate today just continues an extension of this trust and the relationship that we've already established and really builds upon that foundation that we have with Canada.
This Mirabel facility has maintained Canada's armed forces fleet of now aging CF-18s for decades. It has now set its sights on the F-35s. Ottawa initially planned to purchase 88 of those Lockheed Martin jets and has bought 16. But as U.S.-Canada tensions flared up, it announced a review. The government is now weighing whether to run a dual fleet and replace a number of F-35s with Swedish-made Gripens.
The original contract certainly is what we hope. To be able to support up to 88 F-35s.
None of the executives would link the maintenance plan to a minimum number of purchased F-35s. L3 Harris MAS wants federal money to upgrade. This in a bid to transition to a maintenance depot for F-35s from other countries too. But on their short visit to Mirabel, Lockheed Martin executives also packed a message about the benefits of a full fleet of F-35s.
We are very excited, though, about the full 88 airplane buy of Canada, knowing that having a single fleet, what that does with the interoperability with NATO, what it does to ensure one training program, one infrastructure program.
Ottawa hasn't said yet when it will unveil its final decision on the contract. Geneviève Beauchemin, CTV News, Mirabel, Quebec.
That's a saga that never seems to end. The government's dithering over the F-35. A new report is raising concerns about a network of fake YouTube channels targeting Albertans. Researchers say they pose as local voices, pushing Alberta's separation and even U.S. annexation. CTV's Kathy Lee reports these channels have been reaching millions of viewers.
Joe Trotz has lived in Crow's Nest Pass all his life and supports Alberta's separation.
Definitely, you know, down east has really stuck it to Alberta.
The 74-year-old emphasizes most supporters want independence, not annexation. But a new report identifies a network of about 20 YouTube channels posing as Albertan voices, pushing U.S. annexation and Alberta separation. Researchers say they're not real and appear coordinated, using the same scripts, the same clips, and even posting at the same time, together reaching nearly 40 million views.
Some of the channels have actual AI body and avatars performing the content, and some just have AI voiceovers.
Chris Ross, the lead author of the report, says the videos often use real news about Alberta's separation, but distort and exaggerate the grievances, and sometimes getting the facts wrong. The lawyer for the Alberta separation movement warns the fake videos help no one.
Anybody promoting, U.S. annexation or U.S. statehood, they're not part of our movement.
With the possible Alberta separation referendum this fall, researchers say the report's message and timing are important.
It's important for Albertans and Canadians broadly to know which voices are real and which are fake.
In response, Elections Alberta says a new unit is being established to track all forms of deep fakes, misinformation, and disinformation. YouTube says it's reviewing the channels and will remove content that violates its rules. Ken Williams, who opposes separation, worries about outside influence.
There are players, I think, that are taking advantage of chaos.
Trotz also rejects the messaging in the videos.
Totally think that's wrong. I mean, facts are facts. Let them speak for themselves, good or bad.
One thing the report couldn't answer, who's behind the fake videos or where they're located, and that makes them hard to stop. Kathy Lee, CTV News, Crow's Nest Pass, Alberta.
Of course, there's only so much YouTube can do to cut off content like that. Anyway, coming up, with artificial intelligence, geopolitical conflicts, and unpredictable politicians, investors no longer have the luxury of time to react to events. After the break, Lindsay Rosner of Goldman Sachs explains why market reactions are faster and more volatile than ever before. Lindsay Rosner, head of multi-sector fixed income investment at Goldman Sachs Asset Management, has been looking at the accelerated pace of market movements compared to the pre-COVID era. We got perspective from her in a Bloomberg interview. She said investors no longer have the luxury of time to react to major events. Let's have a listen.
Before COVID, we had tons of time that you would have these kind of big market events, and then you would see the movement, and you would have days, maybe even a week, to digest what was going on, pick your spots, and actually be able to put on a position. Things are moving so quick. The cycles right now are super compressed. So that idea that you can be cute and add on weakness and buy those dips, it doesn't happen any longer.
So as you look out, what kind of time horizon are you thinking about? And can you ignore this mess as it evolves from day to day? Yesterday's a great example of that, by the way. Yesterday before the close, we're talking about Vance not going to the talks. Then after the close, 10 minutes later, we're talking about an extension of the ceasefire, an indefinite extension of the ceasefire, just whipsawed from one direction to the other.
I think that's case in point. And so if you look back pre-Iran to where levels are right now, you've almost had complete retracement. So if you look at just that context of 2 months, you should have just stayed invested. The idea that you could have taken off any sort of investments because of this geopolitical conflict, be able to add at the wides, ride that back. I mean, nobody can be that kind of hero in this market. So it's important to have a strategic framework of, at valuation levels, what do you think the right amount of risk is?
So let's work through that. Let's start with where we typically go to first in fixed income treasuries. So we're back to the upper end of the pre-war range, 430 on 10s. I keep hearing that people say we've created value in the yield curve. There's value out there. You should be buying that. Do you agree?
So it's all predicated back to what you were saying before, how quickly we get out of this energy shock. Rates, kind of different than spreads, actually have to care tremendously about inflation. Specifically in the U.S., obviously, there's the dual mandate we heard all about yesterday with Warsh. Elsewhere across the globe, it's more about price stability. So inflation is even more important, and different countries have different kinds of exposure. So in the U.S., we have the ability to create our own energy. That's really important. It was propped as a national security thing or motivation, and it's correct. But so have we created value in the U.S.? On the margin, it feels like we're now going to trade in a higher range because there is permanent scarring from what's happened with oil, right? We don't just get to go back to normal. We have tankers that are stuck. Oil doesn't just come online as easily as it sounds like. We can just say, the conflict's over, let's go back. It doesn't work like that.
Are you surprised at where we're trading right now, given the physicality of the realities on the ground? I mean, you open your note with continued emotional blockade required, and that's how I've been feeling the last 6 weeks.
Yeah, I think you cannot have emotion around these kind of headlines. You have to pull the camera back and see what's actually the underpinnings of various economies. And specifically in the U.S., we're in the middle of earnings. We've had 15% of market cap report. We've had sales up 10%, earnings up 30%. Those are really stellar numbers. That is the actual economy. Oil, important, is an input for some, as a use for others. That is real, but that's not the totality. And so I think if you just get overwhelmed by the headlines and emotional about it, you're going to miss some opportunities to actually get returns in this market.
Are there opportunities outside the United States right now?
There are. We actually think it's in emerging markets. Where we don't think the opportunity is in Europe. Europe's sensitivity to energy and the fact that it isn't homegrown in the way that we're saying that the U.S. and other places actually in emerging markets are as well. We like to lean into EM and out of Europe. And we think that the pricing that's happened, the movements, that Europe hasn't bounced back, makes sense.
This is the geographic disparity. Can you take us inside credit and talk about potential dispersion from sector to sector? How are airlines trading right now relative to, say, the obvious energy names?
Yeah, so the energy story is challenged. Name specific has to do a lot with the debt that they carry. I mean, there's been a lot of headlines this past week about can there be potential avoidance of bankruptcy? You really have to do your homework and look to every single name. So I don't want to say broad strokes what's happening with airlines. Broad strokes, I will say, tech, the mega cap, the hyperscalers, positive. Energy, if you have oil as something that you own and have access to, it's been a good time for you. So it really is very sector specific. And the other thing I'd highlight too that's come through so far in earnings is banks. Banks have done tremendously well, and that's been an overweight in our portfolios for a long time.
Let's pick out that one sector, tech, because tech is underpinning the snapback we've seen in the equity market as well. There was a moment where there was just this pocket of tension that the question was being asked. Were we starting to see pushback, which would force these hyperscalers to cut back on capex and we'd see less issuance in the future? Where are you on that now?
Yeah, so I think we started 2026 with this idea of this is like the show me year for AI. And so as we waited to be shown what AI could do, I think there was some questions. Did these multiples make sense? Oh my God, these CapEx numbers every single year, surprise to the upside. Can that be justified? And I think we've seen probably all of us in our day-to-day lives, certainly from a portfolio management perspective in my seat, the use case for AI. Like, it is absolutely part of what we do every single day. So the show me, we've been shown. And I think that it makes sense, and that bounce back that you have is warranted. I think also what we had in the beginning of the year, really in February, was this baby with the bathwater. Tech, software, SaaS apocalypse, or whatever that phrase was. There was just anything that touched it you didn't want to own. And now people are actually thinking about the fundamentals, and that's important. Back to the emotional blockade. Like, out of the emotions, let's get into the numbers. That's really what's most important.
Software last week, software names, best week. Software on the S&P 500, best week in 25 years. Major squeeze in that sector.
Well, to your point, people are just actually taking a step back. You had all the ups and downs of the Iran war after the SaaScopolis, and they're looking at what some of these real earnings are going to be, and also the impact on the real economy.
Lindsay, I've struggled with one thing, though. I'm still struggling with it today. What is marketing and what is real? And I know you can't do single names, but I'll do a single name. When Anthropic comes out and says something is really dangerous, we can only give certain people approved access, makes you think there's something crazy is happening, and I imagine that the valuation of that company might get bid up into that IPO. How much of it is just marketing, and how much of it is about sucking in capital ahead of some major IPOs in the next 12 months?
So these are, there are many players in this space, and so marketing's function, I think, is to say we are the best player out there. So you can't deny that it makes sense that they would speak about kind of their importance. Whether or not it's important, it certainly feels like cybersecurity is a huge risk out there. And so if they have something that can identify the blind spots, that's important and definitely warrants more focus and more attention.
Up next, we'll bring you the latest headlines and update you on the markets. Xanadu Quantum Technology shares are jumping again, although they're not quite back at that record high. We'll have more after the break. TMX Group is buying CBOE Global Markets Canadian and Australian units in a deal valued at about $300 million US. The Toronto Stock Exchange owner says the acquisition will expand its global footprint and support long-term growth. TMX says it expects the deal to add to profits within a year, but the transaction still subject to regulatory approval. We are going to be joined later by John McKenzie, CEO of TMX Group, to hear more on this deal and what it means for the future of the company. So watch out for that. And there is a look at Rogers Communications jumping. Now, there wasn't a massive beat in the first quarter, but it looks as though investors may be encouraged by a cutback in CapEx. Also, revenue at Rogers Sports and Media grew 82% from a year ago, after the company, of course, increased its stake in Maple Leaf Sports and Entertainment. Rogers added 28,000 post-paid mobile subscribers during the quarter, more than double what analysts had expected. There's a look at Metro, and you can see that stock has actually suffered over the past year, down around 13%. You can see investors selling it right now, down about 3%. Sales did rise in the latest quarter, but the Metro is warning that a strike at its Laval, Quebec distribution center could weigh on results. And there is a look at AT&T, the U.S. telecom giant. It is down today, but revenue and profit in the latest quarter beat expectations. The company saw expansion in its fiber footprint while increasing sales of subscription services. AT&T says moving away from copper lines could cut energy use by 70% and cut maintenance expenses by more than 30% as it pushes ahead in an all-in-one broadband and wireless model. Here's a quick look at North American markets. You can see they are pointing up after U.S. President Donald Trump extended that ceasefire with Iran indefinitely. Interesting, though. I'm sorry. I thought it was indefinitely, but now it's Fox News is saying he's in fact extended it for 3 or 5 days, not indefinitely. Earlier, there were reports that there was no limit on the extension of the ceasefire. Fox News citing a White House official saying, nope, that's not the case. It's only 3 to 5 days. Markets right now don't seem fazed by that. Let's have a look at oil. That's always a good gauge of optimism over peace in the Persian Gulf. And sure enough, oil futures are up 3%. But remember, I know this is a case of yada yada, but people are paying and have been paying more than $140 US a barrel in some markets around the world. And let's have a look at gold today. Gold up around 1%, so hanging in. And our dollar, the Canadian dollar. And you can see that is marginally ahead. Couple of stocks of interest. Let's have a look. We'll have a look at the TMX Group, but also at Xanadu Quantum, maybe a 1 month chart. This Canadian quantum computing technology company up almost threefold in the past month, down from its highs, but jumping again today. And let's have another quick look at TMX Group stock because we are going to be hearing from the CEO of TMX Group at 1:20 p.m. Eastern Time. So you don't want to miss that. And the stock hanging in there on this $300 million US deal to buy CBOE's Canadian and Australian operations. Adobe is launching a new so-called agentic platform targeting business to business and consumers. And the company is teaming up with tech giants Amazon, Google, NVIDIA, and others to build what it calls the broadest agentic AI ecosystem in the industry. We got more from Anil Chakravarthy, Adobe Customer Experience Orchestration Business President. He needs a more elaborate title, I would say. He talked to our Bloomberg partners from the Adobe Summit 2026 in Las Vegas.
Regarding the partnerships you talked about, it's a massive ecosystem that we are a part of and that we are helping drive towards the agentic world. All SaaS companies are becoming agentic software companies. And in our space of customer experience, it's traditionally been a mix of tools, automation, manual processes, in an area where enterprise customers, CEOs, CMOs, chief information officers have been looking for a solution that can really help them automate the end-to-end customer lifecycle and provide those kinds of personalized customer experiences to every single customer. And that's been hard to do before agentic AI. And so now with agentic technology, we announced what we call Adobe CX Enterprise, which is an end-to-end agentic system. That's exactly what you can do, is that one-on-one personalization at scale to every customer across the world.
So how does it change the business model? How is it going to the financial picture going forward for the company?
It's actually growing our TAM dramatically. I mean, we talk about how our total addressable market is now going to be north of $250 billion. It's a vast market because every company in the world, whether it's a B2C company or a B2B company, cares about providing a superior customer experience. And now they can have the technology to be able to do that. And that helps them with their growth. It helps them with their customer satisfaction and loyalty, and also helps them take out costs in terms of the manual processes and tools that they have. And what we see happening over time is that our business model aligns with that of our customers. It'll align with the business outcomes that they're trying to achieve. It'll align with the business metrics that they care about. And we see a lot of our business model moving in that direction and aligning with their business outcomes and their business metrics.
Anil, investors are trying to understand how the rise of agentic AI changes the SaaS business model. So from Adobe's perspective and for Adobe clients, will they still continue to need a subscription to Adobe products and services, or will they be paying or looking to pay for projects or outcomes, just based on outcome, just based on deliverable?
It'll definitely be a mix of both. We see a lot of customers here. We have, customers here many of them are happy with the current model because it's very predictable for them. They know what exactly they're getting out of it, and they're getting business results from it. There are other customers who are saying, as they look at these new technologies and the pace of AI innovation, they look to Adobe to be able to bring that into the software that they already know how to use, whether it's Photoshop or whether it is Adobe Experience Manager. These are all great tools that they know how to use. They're saying, bring it in, your own models, but also bring in, we announced over 30 partnerships with AI companies like Google Nano Banana and others that we can provide through our solutions. And that's what they're looking for. They're looking for a mix of both, depending on what they're actually doing with the software.
One of the narratives that has emerged over the last year, at least when it comes to risks for SaaS companies, and you're all too familiar with this, having followed this closely, is that the rise of AI will somehow make it difficult or make it so these companies no longer need to pay for subscriptions, or at least seat-based models, because maybe they can get Claude to create exactly what they're looking for without paying an ongoing subscription for that. How do you manage the risk to seat-based model?
Yeah, lots of customers here. We've been in a lot of conversations, and the view that you just expressed is not what we hear from customers. A lot of customers think that that's way too simplistic to think that they would actually just use an AI coding tool to replace software. If anything, what they're looking at is saying, look, traditionally for software, we had to take software, we had to customize it to our own needs, and that involved a lot of work. And that work can actually be done a lot more efficiently with the AI coding tools. So they're looking at the sort of the last mile of using the software, making it perfectly tailored to their needs. And that's where they use a lot of the AI coding tools. And that's where their attention is. What is actually being done by the software companies, that actually has a network effect that has the economies of scale, because we have over 20,000 enterprise customers. And we are taking the expertise we have from those customers and making that available. Any single company is not going to have that expertise, and they're not looking to replicate it. If you're a consumer products company or a bank or a healthcare company, you're not looking to become experts in digital marketing or digital customer experience. You want to get the best of both worlds. You want to get the expertise that you get from software companies, but you want the flexibility that AI offers to personalize it at scale to your customers. So they're getting the best of both worlds through agentic software.
And, legacy customers might get it, but I think about a new creative person. What is the reason to buy Adobe products when they can use free LLMs to create videos and pictures? What's the argument here?
Yeah, I mean, if you're anybody who is doing it for, let's say you are a creative professional or a freelancer, or you're even doing it as a gig, for example, you want to be able to get the benefit of not just the AI models, which obviously anybody can get. Then how do you differentiate yourself? That's where if you can bring the power of the AI models and then combine it with the capabilities that we provide, built over time. So if you can say, hey, through Photoshop, I'm able to access 30 different models. I can use that as the starting point, then I can add my own unique touch to it. That, again, you're getting the best of both worlds. And we believe that that's how you produce content that stands out. Otherwise, if you're doing the same thing out of the AI models, then all content is going to look the same. How are you going to stand out? And if you don't stand out, just putting content in front of customers, if they're not going to click on it, or they're not going to take it to the next step, it's not going to be effective. So we believe that for content to stand out, you need both. You need the AI models, and then you need to add your own unique touch, your own brand to it to make it stand out.
Coming up, hot picks. We're going to zero in on 3 ideas in Canadian stocks. That's ahead. Time for hot picks. Today, we're zeroing in on 3 stocks in the Canadian market. Our guest has WSP Global as his top selection. We are joined by Chris Murray, Managing Director in Institutional Equity Research at ATB Capital Markets. Thanks very much for joining us, Chris.
Thanks, Andy.
Tell us about WSP Global. Remind us how they make most of their money, please.
Yeah, so WSP Global is an international engineering consulting firm which has a wide range of clients doing everything from water through power. They do transportation, buildings. And so they've been involved in, for the most part, building infrastructure around the globe for many, many years.
What attracts you to the stock right now? And I see it is down over the past year.
It really is. And I think this is really what creates the opportunity and why we like it right now. So one of the broader themes around AI has been the disruption in a lot of the services businesses and consultancy businesses. And we think, what's been misunderstood about the engineering space is the fact that they've got some deep knowledge, deep data. And while AI is really, I think, going to be an important part of the go-forward story for the engineering space, there's been some concern about that disruption. We think, given the years of data that they've accumulated and their ability to use some of these AI tools, we think actually it's a pretty positive opportunity set for them, which is going to help them grow in the future.
And they have a big franchise. Sorry, Chris, you may have mentioned this. Do they have a big franchise in electricity and power, which is such a hot area right now?
They really do. In fact, they made a fairly large acquisition in the U.S. last year of a firm called Power Engineers. Actually probably makes them one of the largest power engineering consulting firms in the world. And so when you think about data centers, demand for power, transmission, they're certainly going to be intimately involved in a lot of that across the globe.
Your next idea is NFI Group. Maybe we could put up a 5-year chart because they were plagued for a good while by spare parts glitches and shortages, but they now have a $13 billion backlog.
Exactly. And I think that if you think about NFI, it really was one of those manufacturing stories negatively impacted by COVID and some of the call it the echoes of COVID that impacted supply chains. We're really on the far side of that now. And what we are seeing is good demand. You've noted the large backlog, but I think what's also been important is that the quality of that backlog has increased materially. So what we're expecting is over several years, to see margin expansion and earnings growth. And along with that, deleveraging, which should, we think, coupled with the improved earnings, bring leverage and debt levels down. All that combined, we think you've got earnings growth on top of multiple expansion, which also translates into a pretty powerful stock pick.
And they have a franchise in electric buses anyway, although bus operators are very slow to make decisions, it sounds like.
Yeah, I think the way to think about it is they have the dominant market position in North American transit and North American coach buses. They've got the ability to operate on both sides of the border. So tariffs, while something that we keep an eye on, is something that they can manage. But they're generally also propulsion agnostic. So if there is a shift away from EVs to maybe conventional diesels or hybrid, maybe CNG buses, they've got the ability to fulfill all those orders. And right now, they're deeply embedded with all the different transit authorities across North America. And you're starting to see the opportunities that be pretty powerful.
And then finally, Boyd Services Group, the big chain of auto repair shops. What draws you to that stock, Chris?
So it's been interesting over the last few years. And again, this is part of this consumer pressure around the spike in inflation. And so what we've seen over the last little while is insurance rates, particularly in the U.S., had been seeing very significant increases. We've started to see some normalization in that. We've also started to see some normalization around the price of cars and the industry turning. Now, on top of that, Boyd's also been very active in continuing to do acquisitions. They did a large acquisition of a firm in the Southeast U.S. called Joe Hudson last year. That gives them additional growth and opportunities to grow. So we're starting to see a return to positive same-store sales. That started to occur in Q3. Q4, the numbers were a little bit below our estimates, but we expect that we're going to see continued improvement as we go through 26. And on top of that, expect that there'll be additional consolidation of the industry, where over the next 4 to 5 years, we should see earnings double.
It's interesting that stock is dropping lately, cars are so expensive to repair right now and technologically complex. I think some see that as an advantage to Boyd because it's a big shop and they can afford to invest in complicated equipment.
Exactly, and I think part of the argument that we've had is that it's really the insurers who are trying to find better ways to run the system, be that technology. And so what they're focused on is moving more work to the more sophisticated operators who can handle, to your point, more sophisticated electronics, who can handle scanning and calibration, who can handle more exotic materials, and offer them a cost of repair overall that's while not much lower than the cost of the parts, is more efficient overall, which is a better outcome, I think, for everybody involved. So this is where we think that you're going to see that good growth come through.
You have engineering training yourself, Chris. Do you think cars have become too complicated?
I think what we're seeing is the evolution of a number of standards. If you think about both fuel efficiency standards, safety standards, I think in order to achieve some of the goals that we've set, that you're going to need these technologies to evolve over time. So I think we'll continue to see cars continue to get more complicated. I mean, certainly there's a lot of discussion around things like self-driving vehicles and the implications of AI and what that'll do. But yeah, no, I certainly think that trend isn't going to reverse anytime soon.
Thank you very much, Chris. Really appreciate it. Chris Murray, Managing Director in Institutional Equity Research at ATB Capital Markets. Coming up, we'll check out some of today's notable analyst calls. We'll be taking a look at MDA, Nutrien, and Cameco. Remember to tune in at 3 p.m. Eastern today for Know Your Options. We'll be joined as ever by Chris Tom of Moat Financial, and he'll be taking your questions on options trading. Know Your Options at bnnbloomberg.ca is the email. Okay, let's check out some notable analyst calls here. And don't miss Know Your Options today. Canaccord is starting coverage of MDA Space with a buy rating and a target of $56 Canadian. The firm sees MDA being, quote, in the sweet spot of the broader aerospace and defense universe, citing growth for the company, credibility, its track record, and upside potential. Canaccord thinks MDA is well positioned to benefit from expanding market opportunities in multiple areas, including defense, major satellite communications, and space. Oppenheimer is raising its price target on Nutrien to $80 US from $78 and sticking with an outperform rating. Now, Nutrien, along with other fertilizer stocks, soared when the Gulf Strait of Hormuz was shut down, cutting off nitrogen exports from the Persian Gulf. Stock has given up some of those gains. Oppenheimer, though, is increasing targets in the agricultural space, saying that the sector is likely to post healthy Q1 results. Sentiment in the industry apparently remains resilient. But there are likely, Oppenheimer says, to be higher for longer fertilizer prices. And then Cameco. CIBC is actually lowering its price target on Cameco to $200 from $202. Not a very big reduction, but sticking with an outperformer. This is part of an adjustment of targets in the gold and base metals group as part of a Q1 preview. CIBC believes that a 20% sell-off in gold from its January high will support a bounce in the asset's price. The analyst remains optimistic on gold. CIBC has also adopted what it says is a more constructive outlook on base metal equities. And let's have a look now at the markets. TSX, we'll start off with that one. Toronto doing pretty well this year, comparatively speaking. Our market now up just over 7% in 2026. S&P 500 is up around 4%. The Nasdaq is up just under 6%. Some stocks of interest, Rogers cutting back on its capital spending and also reporting almost 30,000 postpaid wireless subscribers addition net. Celestica is teaming up with BCE, our parent company. I don't think there's any actual dollars mentioned here, but the two are working towards building what they call sovereign AI capability, aka Canadian AI infrastructure. So BCE, parent of BNN Bloomberg, teaming up with Celestica, huge manufacturer and installer of technology equipment. They're developing what they call a Canadian sovereign AI infrastructure stack. They're helping to advance a sovereign approach to Canadian AI infrastructure. The idea there being that Canada isn't totally dependent on foreign companies. And interesting political question, of course, how is AI going to be regulated and where is the data going to be located? And Enbridge getting a court setback here. They're in a face-off with Michigan. It's a messy legal dispute over the so-called Line 5 pipeline. but the U.S. Supreme Court saying, nope, that has to stay in state court, can't go to the Supreme Court. Thanks very much for watching The Open. Morning Markets is ahead.